Hi guys, going to give everyone a minute or so to sign in. We've got a more than usual attendance today, so I'm seeing quite a few people click in today. So give us about a minute and we'll be with you. Hi guys, welcome to this week's webinar, which is going to be on the latest property trends. So I'm going to hand over to Paul. Paul's going to run you through the majority of this, and yeah, can have some questions at the end.
Good afternoon. Firstly, UK property trends, latest trends 2018, what are we going to expect? Been quite a few changes, quite a lot's been going on, some very surprising developments in the market, to be fair. The way the marketplace operates, the way the people within it operate. As a country, the UK property market's had to endure probably way more than any other international markets in property have had to over the last few years. We've had that political and economic instability that surrounds the Brexit vote, and it's all created a bit of an issue for clients looking at the UK and wondering what to do next. Well, here we go. Foreign investors, as you can imagine, were initially scared off. Brexit led to a lot of uncertainty. People were unsure what it meant, but what it did do was that the value of our currency, sterling, did drop dramatically. In some cases, we saw a deduction of 30%. Now, obviously, as an investor, price is very key. And no matter how unstable you think a country is, if you see a 30% reduction on the value of a property you were looking at maybe like 2 or 3 months ago, you're going to be very hard pushed to ignore that. And with that in mind, we saw an unprecedented demand from many foreign investors. It led to an interest that we hadn't seen. It was unprecedented in our experience of the market.
I think actually I'd say that our 2 biggest months on record on history are the one prior to the brand new stamp duty legislation coming in. And as soon as like you said, as soon as the foreign investors realised, actually, I'm literally overnight saving 20 to 30% on a property.
Yeah,
it was huge.
Yeah, I mean, we had an August return on figures, which was the highest August we'd ever had on record as a company. So that gives you some example of the impact it had. And despite the fact that the currency has now drifted back, and that is obviously has an impact, and it has slowed up the demand. There still is a reduction, roughly around 15% across the board for most currencies, and that has kept the interest in the UK's property market at an all-time high, at a relatively good level for foreign investors. So the impacts we're seeing from the Brexit is limited. As I say, it's perhaps made people pause and have a little think about it. And we have seen perhaps more of an impact around London, perhaps being more international and more speculative at these higher levels. But generally, for us as a company where we're looking to invest, for investors, it's seen a great impact for the foreign investors, and they're coming to us in their droves. Next up is an interesting one: lifestyle changes. It seems that the millennials have had a different way to live. They've come to the market. They now live their life in a way that they sort of use their income in more interesting ways. They don't necessarily want to be house owners. It's perhaps deemed a little bit boring. They've embraced the rental market. Obviously, a lot of youngsters have entered the rental market because of affordability to begin with. And as they go through their life stages, they meet women, they get married, they have partners, they have children. They remain in the rental market, and they become rentals for life, it would seem. And this sort of new population or sort of type of lifestyle leads to families sitting in the rental market for life and spending their money on experiences, good holidays, just life experiences. And that has a big change. It's a generational change, but it's one we're seeing. We're also seeing an increase in the amount of single households. So demand for property is continuing to grow. We're seeing a higher divorce rates, and with life expectancies much higher than they were many, many years ago, you're seeing an increase in demand, and there's a lack of affordable housing on the back of that. And this all leads to a continued upward pressure on the rental market.
It's not too dissimilar to, you go to places like Germany, right? And you go to Berlin, and I've got friends and family out there, and it is just a rental market. And in Madrid as well, people just don't think, well, whereas it's ingrained in us, buy. The first thing your parents do, get on the ladder, is the expression, you go to sort of European cities, and it's not like that. There's houses and flats and apartments that have remained in the family for generations, and then the family may rent, and when the parents pass away, they may go back in there, and then the next generation rents. And so it's not too dissimilar. And I personally believe over the coming years that we'll see our nation turn into a nation of renters. I just feel that that's the way it's going, and that does benefit anyone who does have the money and can afford to get on the ladder. I believe that they're going to really benefit from that.
I think we've seen the government do some things that have perhaps streamlined the market, made it more professional. I think they realise that the rental market is growing, and it has to be more professional. And some of the legislation they brought in is to make that a more professional market, not like a race to the bottom in quality. And realise that as an asset class, rental properties is something that's going to be here for good. And as a population, we may start becoming a population of renters. Another important thing to talk about is the sort of what happens when these new infrastructure products come in, these new big projects they have, like Crossrail, HS2, HS1, and the way sort of like these areas that we're seeing. I mean, what you're seeing now is as these big infrastructure projects come in, they impact on the prices of property. Pure and simple. They did a study in London, and basically, if your house or property was near a tube station, and you were 2 or 3 rows nearer than others in the area, your property would be thousands dearer. It would have an impact which was quite marked on your property price. And we're seeing this in a very similar way. We've caught up with HS2 and HS1. We've seen a northwest pick up in value. Birmingham's price, you're going to be less than 35 minutes away from London when HS1's done. You're going to be an hour away from London when Manchester HS2's done. That's impact on prices. Crossrail, when you look east and west, Reading through to, say, Shenfield and Chelmsford out in Essex, prices up there in the last sort of 2 to 3 years, or 3 to 4 years, should I say, have jumped probably around 25%. And the impact on it is huge. So it cannot be ignored. And this sort of new widening of these commuter hubs is creating new areas, new hubs where people can live, and impacts on prices. And obviously, if you're based in Chelmsford and your property's jumped up 20-25% over the last 4 years, it's going to impact on other parts of areas beyond Chelmsford or just outside Chelmsford. So these impacts of these infrastructure projects are not to be ignored. They'll carry on whilst the project's being delivered. And once that project's delivered, they only start to flatten out towards the end when the full effects happened. You see it, the price is there, people have moved in, it's already operating. At that point, it levels out and it starts to just move in line with the rest of the market. But you cannot underestimate the impact of these infrastructure projects. And although some of you may say, oh, well, it's already happened, I promise you now, until the moment they're delivered, it will keep impacting. And that is a reality. Next key driver, mortgage rates. Talk in the market at the start of this year, rates were going to start moving. We're at unprecedented low rates of 0.5%. You can still borrow money at ridiculous levels, 1.5%. Buy-to-let mortgages average anywhere between entrance fee around 1.5 to 1.8%. You can do as introductory offers, but buy-to-let mortgages sit around the 3.5% mark on average. Again, still very cheap, historically low. There was a bit of nervousness at the start of the year. Bank of England indicated that they're hiking rates. Things were going to start to move. I think we need to bear in mind at one point, if they doubled rates, we'd hit 1%. If they quadrupled rates, we'd only be at 3%. I mean, these numbers are so low. It bears consideration the cost of getting into the market. I don't see rates in the UK going beyond, well, I would sit 5% as a high. I don't see rates doing what they used to back in the day when I was buying houses when I was in the late 80s. We saw 15% interest rates. Those days have gone. We have a very, very fluid market. Inflation remains relatively low. The drivers there are in place. We've seen the Bank of England change its view in the last 2 or 3 weeks. There's an article came out that the Bank of England made an announcement, and they basically backed away from hiking rates. They said some of the figures were slightly distorted. Inflation wasn't as strong as they was initially thinking, and growth wasn't as good. So with that in mind, I don't see interest rates moving much towards the end of this year. I maybe see one increase this year, which is the market's pricing in. But beyond that, I don't see the trajectory being quite sharp. I think it's quite slow, quite gentle, and I don't think mortgage rates are going to drive too high for some time yet. I think we have plenty of time left, and I think that sort of lower rates and the ability to borrow money at those levels is going to be there for some time to come, which is going to keep an interest on the property market and the prices. So that I still think is a key thing to keep an eye for. And then the last little thing here, oops, we had a quick miss. We have the we're discussing just a quick one, which I wanted to mention as well. We were talking about commuter hubs and the sort of from the infrastructure projects. You've got another bit of story I did miss out. Apologies. It's this super commuter community. With the advance of technology, I think you now have to start, new commuter hubs can start developing. We have a population now that can live 2 hours, 2.5 hours away from the likes of London or Manchester or wherever, and because they probably spend maybe 1 day a week in an office, and the technology advances we've had allow people to move to areas where they have a better lifestyle, and they're in more sort of picturesque villages. So it's key to look around at maybe other major centres, major areas that move these sort of commuter hubs, or people's ability to buy houses in different areas of different parts of the world that they wouldn't otherwise consider. So I think a big impact on prices is going to be these areas that are desirable, places that people want to go and live. They're sort of lifestyle choices. You're 2 minutes from getting on in the Lake District, or wherever, just somewhere really beautiful to go, near the Downs down in Devon, or in Cornwall, or on the coast down in Dorset. Just areas where people want to live, and with the new technology and that ever-increasing ability to live and work from home, I think these new commuter hubs will carry on growing, and that will impact on prices and house prices in those areas.
Well, we had a meeting, didn't we, with Savills yesterday. We met Savills, and one of their research reports shows that Cornwall actually is the biggest and most up-and-coming area in the UK. Not just because obviously the people there that are buying properties, not just because of the people buying second homes that they take the kids to on holiday, and the retirement homes and whatever it may be, but also there's one particular area, not far from St Ives, where there's huge regeneration going on, and there's great opportunities down there. We're just in negotiations with a few developers at the moment, and what they're basically saying is that, like Paul said, these super commuters, where people are starting to do in sort of like your Tuesday, Wednesday, Thursday in London, but your Fridays and Mondays at home. So they've suddenly, they're back Thursday night, they've got Friday, Saturday, Sunday, Monday at home, and then they're back down into London Tuesday, Wednesday, Thursday. So they're now starting to buy in the areas that they want to live, not just because it's a half-hour commute, but they're going, do you know what, I don't mind commuting for 2.5, 3 hours, 4 hours on the train. I can do a bit of work on the train, quite comfortable. I'm only doing it twice a week, and I'm with the family in a great location. So certain areas like that are tipped to become the next best buy-to-let hotspots. So places like we said, Cornwall, but in particular this Howe, where it's going through a huge amount of redevelopment. And also there are certain tax breaks. So we will still have the typical fantastic buy-to-lets. We'll still have the Liverpool, the Manchester, the Leeds, the Sheffield, the residential, the student property, whatever it may be. That's still there. That's not going away anytime soon as far as we're concerned. But now we're seeing other avenues where people can get tax breaks on holiday lets, tax breaks from on the entrepreneurial rollover scheme. And they are typically in places such as the Devon, the Cornwall, and suddenly you get a Savills report that says Cornwall is going to be the next best buy-to-let area, or the next best growth area, and suddenly a huge influx of interest, and that's the next step as far as we're concerned.
So yeah, I mean, all bodes well. So I mean, just to bring this to a conclusion before we take any further questions from you guys. I mean, in general, we just feel that prices for 2018 are going to remain steady. We think key regeneration areas, as we've always mentioned in the past, and areas linked to large infrastructure projects, and will continue to attract great interest and keep those prices elevated. I think in an environment where we have sort of house builders are struggling to keep up with demand, that pressure is going to continue to keep the prices elevated. And I think generally market is looking good. I think the only area where there's to be a little bit of a drop, and one which I think is down to affordability, is I think that's London. This sort of gap that was created with the moves in the market over the last few years have led to the affordability gap being huge, and it needs to drop in line with areas like Manchester and Liverpool. Maybe not as much as that, but where you're sort of seeing average house prices are sort of way beyond the possibility of ownership from sort of like your average earning income man in London or that area. It's that affordability gap will create a reduction in prices. So that link, and that's what we expect to see in London, but elsewhere in the country we're expecting good things and a positive move, and all those regenerations area, the northwest, parts of the northeast, now down towards Cornwall and those areas, we expect to see a steady price increase and yeah, positive outlook for the property market as far as we're concerned.
Okay, guys, over to you. Any questions? There's quite a few of you. So any questions? What I might do as well is, because there might be a large number of questions, I will also answer these after in written form. So I can always send an email to you in regards to this. So we've got a couple of questions coming through. Okay, the first one, you mentioned about Cornwall. Where is Cornwall? Okay, so Cornwall, for a lot of you overseas guys who may not know the area as well, is on the southwest coast. So you're looking right at the tip, and it's typically around about 5-6 hour drive if you get right down there from London. However, there are decent transport links. And what we're finding, I mean, even when I was early on in the city, I had a few directors that I worked for who had second homes down there, and they did that commute then. They did the Thursday night and the Monday night commute. But typically now we're seeing more and more companies are open to people who are, going to work 3 days a week from the office and 2 days a week from home. With the technology the way it is, you certainly don't need to be tied to that desk. As we all know, at the a mobile phone, our emails follow us around. We can take a call at any point. So being at the desk makes no difference.
What's better than being sat in the English Riviera, as they call it, looking over beautiful landscape, superb beaches, sea, and that's what these things offer. This particular development we have is a brand new development being built up. It's outstanding apartments, all got ocean views. Next to St Ives, near that sort of, if anyone you guys know Rick Stein, the chef. Again, all made famous by him down there. Beautiful parts of the world, outstanding coastline, and what a better backdrop than to be sat there in your own home office looking over that sort of environment. It makes working a pleasure.
It's also motivation. I think they did a study in Sweden, and this one particular company, he had chains on his desk that actually lifted the desk up to the roof at a certain time. So what that basically meant is, if you hadn't finished your work, it was tough. The desk lifted up. The boss at the company was simply saying, "Well, you can't work anymore. You have to go home." So, and it created more motivation when people had, rather than thinking, "Oh, one last email or one last phone call," people went home, spent time with their families, come back refreshed the next day. And I think that's the same thing. A lot of people are realizing, well, actually, maybe that's the way forward, rather than, going back to the old school sort of, it was a competition. Who did the most hours in a week? Now it's like, well, do you know what? Who's got the best lifestyle? And the fact that you still are productive to me is the most important.
I think as an investor as well, it's quite important, because if you are an investor looking at perhaps buying into the next part of the UK that looks to be growing, and Cornwall definitely is there, it represents a great opportunity, because not only can you use it, holiday rents are great. You can rent a property out for maybe 2 to 3 months a year. That will pretty much guarantee you the income you'd get over a year elsewhere. And then you use the place for yourself the rest of the time. You don't get the same wear and tear. It's just a great little option, and it doesn't attract the same sort of tax as your typical buy-to-let investment does. So it's a very, very interesting and perhaps an attractive investment choice for those looking to invest in the buy-to-let market.
And again, we've got another question here. Where else to buy-to-let? Well, again, all depends on budget and what you're looking for. We always say the same thing, are you looking for 1 year, 3 years, 5 years, 10 years? If you're looking for 1 year, don't buy and buy to let. It's a waste of your time. You want to buy something a bit more shorter term. Anything over 3 years minimum, I'd actually advise 5 years, but if you're desperate to get into the buy to let market, 3 years is a bare minimum that you want to be in that market for. actually benefit from it. Because one year people think, oh, just duck in and duck out. Well, that's all well and good buying a property for maybe 200,000, duck in, duck out, and then it's worth 220. You made 10%, but actually you haven't. By the time you've actually paid your stamp duty and your cost of lawyer on the way in, lawyer on the way out, you probably actually made very little, if not a loss. So we always say minimum 3 years. And typically the areas are the same. Not much is changing. The Manchesters, the Liverpools, the Leeds, the Sheffields, those kind of places. But as I say, it all stems from you speaking to someone, making sure that we've got the right products and you've got the right outlook, right attitude, and we can work it from there. Guys, what I'm going to do as well is, rather than keeping everyone online now, we've got a list of questions we've got sort of like 79, 80 questions to go through. So rather than doing that, what I'm going to do is I'm going to get the brokers to single-handedly reply to you over email to these particular questions, and then that should wrap things up here. And we'll get those questions answered. Should be by the end of today, early part tomorrow. Anything else you need, guys? You know where we are, and take care and have a lovely rest of the day.
Cheers.